Now let's talk about our 10 generally accepted auditing standards. Now if you look in your notes, prior to the issuance of the clarity standards, we were required to apply these 10 generally accepted auditing standards. Under the clarity standards, the Gaas generally accepted auditing standards were repositioned into what we call the objectives of the format of the clarity project. So when we look up here back at the different format, we had introduction, objective, definition, requirements, and application. So what we did is we said, okay, what are we trying to accomplish? That's our objective. So that's kind of where our generally accepted auditing standards apply. We're still using generally accepted auditing standards as we do our audit. It's just that under what we call, again, a PCAOB, and you're going to see this again and again throughout the course. PCAOB audit is a public company, so this is called an issuer or a public company. And a public company, that means that they're required to report or issue statements with the SEC, Securities and Exchange Commission, because their stock is publicly traded. We'll learn in the regulation exam under the 1933-1934 Federal Securities Regulations Act, you've got to do a 10K annual audited statements, a 10Q quarterly reviewed, 8K significant changes. You've got to do that if you're a certain size company, over 10 million in assets, 500 shareholders, blah, blah, blah. If you have certain rules that you comply under, then you have to issue this information. So you have to do that. So when we talk about an issuer, that's going to be PCAOB, issuer, public company. So that's a public company. When we talk about a AICPA non-issuer, or let's say ASB, Auditing Standards Board, that is a non-issuer, that is a non-public entity. And a non-issuer, non-public would be Roger C. peer review, right? Am I publicly traded? Not yet. So that would be a non-public, non-issuer. So we still have to deal with the clarity standards. All right, those are the standards we're following. But again, Gaas still applies. And I'm going to, throughout the entire course, I'm still going to use, I love the mnemonic Tippecanoe. And you'll learn this in just a minute. I love it because it helps students really understand what we're doing in auditing. It helps you to understand the flow of the audit. Because I know in college, you try to memorize, you take an exam, blow it out your brain. Here, it all ties together. We're talking about planning and going into internal control and then obtaining sufficient corroborative evidence that I talked about, and then drafting the report and what goes in the report and so on. So all of that flow still applies, whether it's public or non-public, whether it's an issuer or non-issuer. It's just that for the PCAOB public company, we're still going to remember the mnemonic Tippecanoe because that's going to be really important as far as our 10 generally accepted auditing standards. So, with our standards, it says here, what are the standards? It's a way of measuring the quality of the auditor's work. So we're going to talk about our 10 generally accepted auditing standards, and that's called a measure of the quality of the auditor. Because what we're going to look at, both for public and non-public, is the quality of the auditor's work. Did you do enough work? Because if you give the wrong opinion on these statements, what's going to happen? You're going to get sued. And if you get sued, what is your best defense? That you were not negligent in the audit. How can you show you were not negligent? You can show by adhering to these standards. Whether they're generally accepted auditing standards, whether it's the clarity standards, you adhere to those standards established by the profession. So as long as you do that, you're going to be okay. Now, under generally accepted auditing standards, they're broken up into three main categories called the general standards, the standards of field work, and the standards of reporting. So we're going to look at all of these different standards because that is the three different categories. We've got general, fieldwork, and reporting. Now, under the general standards basically say, should I take the job? So what we're looking at with the general standards is we're trying to say, okay, should I accept the job? So if you look in your notes, general standards apply to all aspects of the engagement from an acceptance to completion. Field work only apply to the portion of the engagement devoted to gathering of evidence, which is your internal control, obtaining evidence. Reporting reply or relate to the audit report. So you'll see here in your notes a measure of the quality of the auditor's performance. So the first one, how qualification of the auditor, and the quality of his work. So when we look at general, qualification, and quality of work. So, should I take the job, and am I qualified to take the job? Do I have the training? Do I have the proficiency? Do I have the experience in this business and industry? If I do, great. If I don't, you can still take the job, but you better get familiar with the business and industry, or you may give the wrong opinion and get sued and go to jail. Hey, come on down. We've got room for one. All right. The first general standard states technical training and proficiency. The audit must be performed by a person or person having adequate technical training and proficiency. So the first one we're going to call technical training and proficiency. Now, when we talk about training and proficiency, that means you have the proper training, you have the proper education, you have the proper background. That means you're properly trained. Proficiency means maybe you've done this type of audit before, so you're proficient as an auditor. For example, when I started working at Deloitte & Touche in downtown LA many, many moons ago, back when I was on the dating game, check it out on YouTube. So way back in that day, and you'll watch it and you'll go, who is this guy? It doesn't even look like the person today. Hey, we all change 10, 20, 30 years later. So anyway, the point is that when I started at Deloitte, I didn't really have the training, the background, but they gave me continuing professional, CPE, which is continuing professional education. So in some states, you need maybe 80 hours every 2 years to keep your CPA certificate active, maybe 20 hours minimum a year. That's part of showing that you're proficient as an auditor. So you'll see here, proper education in accounting, knowledge of the industry and business, practical experience, and we'll call that CPE, which stands for continuing professional education. The second one talks about independence. And with independence, that means we want to make sure that if you're giving an opinion on these statements, you have again, you're not biased one way or the other. Because how objective are you going to be if you have an interest in the client? You're not. That's why we have specific rules that talk about independence. We're going to have these under the Clarity Project as well. But here, it's one of the specific general accepted auditing standards that says you need to be independent. So when you look in your notes, it says in all matters relating to the assignment, an independence and mental attitude must be maintained by the auditor. Now, ability to act with integrity and objectivity. Independence means you, your spouse, dependent kids, dependent relatives, and so on. I'm going to cover this in more detail later under the Clarity Project, but it's still the same, very similar, independence. So what it says is you need to be independent. Now, when we talk about independence, independence means no direct and no material indirect financial interest in the client. And I'm going to expand on that later, but no direct, no material indirect. Let's say I'm auditing this entity. If I own stock directly in the company, if I give them a good opinion, what happens? Stock price goes up, my investment goes up. That's called a direct interest. So if I have a direct interest in the company, it doesn't matter if it's material or immaterial, I can't do it. No material indirect. Here, that's an indirect interest. So I don't own stock in the company, but I have money in a mutual fund, a mutuality of securities. I don't control what they buy or sell, and they invest in the company. There it says no material. So here, no material indirect. As long as it's not material to me or the company, then we're okay. But that deals with independence. So what have we talked about so far? We said, should I take the job? This is a way of measuring the quality of the auditor's performance. Did they do enough work? If you adhere to these standards, you're generally not considered to have been negligent. General qualification of the auditor, quality of his work or her work. Training and proficiency. Do I have the proper training, the proper background? Do I understand the industry and the business? Also, CPE. Do I have continuing education? Independence. Am I independent? Clear mental attitude. That means acting with integrity, acting with objectivity. So I'm objective, acting with integrity. And you'll see that terminology in a couple of minutes in a few pages when we talk about it in detail under the Clarity Standards. The third one says, hey, you need to act with due professional care. Due professional care means you're acting with skill, with due diligence, without negligence, with a critical review of the work done at every level. So that's what so when I'm out there doing an audit, I need to be able to act with due professional care, with skill, due diligence, without negligence, a critical review of the work done at every level. So that means that if I'm the partner, I've got to review the manager reviews the senior reviews the new hires. You've got to go all the way down that chain of command. So you need to make sure before you take the job that you are able to act with skill, with due diligence. If not, either get the information, get the knowledge, get the experience, or don't take the job. So that's what we're looking at with our general accepted. Those are called the general standards. The next standards are called, and if you look in your notes, due professional care must be exercised, critical review of the work of judgment used at every level, skill and care of a prudent CPA, preparation of complete work papers, operating without negligence, which we call due diligence, professional skepticism. We mentioned that earlier. Professional skepticism means you question and doubt everything. How do I know this? How do I know that? I need sufficient, appropriate audit evidence to corroborate this change. That's what you need to be able to do. That's what acting with due professional care means. Also acting with competency and diligence. Being competent, you know what you're doing, and diligent. You're really working through the detail to make sure that you're obtaining the information that you need. Now, with our 3 standards of field work, it says how the audit is planned and how the audit evidence is accumulated and evaluated. So this deals with how we're planning it, but also how we're gathering the information. Because what is our overall objective? To give an opinion. In my opinion, cash, receivables, inventory, fixed assets, intangible assets, notes payable, bonds payable, stockholders' equity, all of these things are presented fairly. Well, how do I know? Because I need to be able to obtain that information. So this talks about planning it and how you're gathering the information. All right, so the first one talks about planning and supervision. Planning and supervision. So that means that you want to make sure that assistants are supervised and that the job itself is properly planned. And we'll talk later on about planning procedures, planning considerations, and I'll give you wonderfully exciting mnemonics and memory aids as a good way to remember what falls into that area. So you'll see here the auditor must plan, adequately plan, and must properly supervise. The second standard of fieldwork states internal control. Now with internal control, we're going to spend a whole section on this. So down the road, we're going to look at this whole section on just internal control, but this is really important. It says that we need to look at the system of internal control. Now, let's think back. Whose statements are these? Management's. Whose internal control system is it? Management's. So here's the question. If management is in charge of the internal control system and the results of internal control are these numbers, then what do we have to do? We have to see, is it set up properly? Is it set up properly and is it operating effectively? So what we'll look at in the internal control section is we're going to have to look at the client's system of internal control and we're going to try to understand whether or not we can rely on their system. Now, as you'll see, if reliance on internal control is high, that means we think the controls are being adhered to. For example, internal control. I want to buy something from you for $100,000 and I want to buy it on credit. Well, then you're going to say, what are you going to ask? Does he have good credit? Okay, let's do a credit check. I want to borrow money to buy a house. Let's check his FICO score. I want to get a new credit card. Let's check. So that's what we're doing. So if the company is checking your credit before they authorize the sale, that's a good control. If all of a sudden we go, hey, look at all these accounts receivable. Have you checked their credit before you made the sale? That would have been a good idea. A little bit late. So you want to make sure that ahead of time you're checking their credit. So if you're doing it, hey, I can rely on the control. Now that affects the next standard, which says the third standard of fieldwork says you need sufficient, appropriate audit evidence. So here's what it says. You need sufficient appropriate audit evidence, sufficient appropriate corroborative audit evidence. So with this corroborative audit evidence, you need enough good evidence to corroborate the assertions that management is making. And we're going to learn about all these different assertions down the road: presentation and disclosure, existence and occurrence, rights and obligations, completeness, existence, rights. So For example, when you look at their statements, and I mentioned this earlier, when you look at their statements, management is asserting cash. They're asserting the cash exists, the cash is complete, the cash is not restricted, the cash is theirs. That's what they're asserting. They are asserting that it exists, that it's theirs, that it's complete. So we do cutoff testing, periodicity, and so on. That's what they're asserting. What is your job, should you decide to accept it, is to obtain enough good evidence, sufficient, appropriate, audit evidence in order to corroborate what the client is asserting. So that's sufficient and appropriate. Now, how do we obtain that evidence? By doing what we call substantive testing. And you can say substantive or substantive. But the bottom line is, if I want to audit receivables, when I look at your balance sheet and it says you have $1 million of receivables, I can't just go, okay, cool, that's it. I've got to go corroborate or substantiate. I need enough good evidence to corroborate. So what is a good test for receivables? How about confirmations? So I'm going to go outside the company and say, hey, according to their records, they're saying that you owe them $100,000. Is that correct? And the person's going to say, yeah, that's correct. I owe you the money. Cool. Or they're going to say, I've never heard of that company before in my life. And we go, oh, that's a problem. So that's what we're going to have to figure out, like, have we really? So that's how you corroborate. So we use positive, negative confirmations, blank, and all that good stuff, which we'll talk about down the road. So notice here, very important, if reliance on internal control is good, then we'll do less substantive testing. There's an inverse relationship here. Vice versa, if reliance is low, we'll do more testing. So here's how it works. What we're going to do is we're going to have to try to figure out how much evidence we need. We're trying to give an opinion. So if reliance is high, that means internal controls look good, then we can do less substantive testing. Now, what is an example of reliance? You go out and you're trying to see if they check credit before they authorize the sale. Then, before they authorize the sale, do they check if they have the goods? Then, does someone check that if the goods they're sent, they're billed for the right price? And then, are there someone checking that when the bill comes in, it comes in with a check? And then they're checking to make sure that the check gets deposited into the client's account, not an employee's account. And then they do a bank reconciliation. So that's what we're trying to do. We're trying to make sure that the flow is good. As far as substantive testing, how do you corroborate? That's an example of doing receivable confirmations. That's to corroborate or substantiate. So as we're going through it, reliance means, can we rely on the controls? Substantive says, now let's corroborate or substantiate the dollar amount. So think of reliance as internal control, whereas substantive is to substantiate or corroborate the dollars. Now, as you're going to learn later on in this section, if reliance is high, that means we think control risk is low. Therefore, we're willing to let our detection risk go up. Therefore, we'll do less substantive testing. So it kind of flows around in this direction. Reliance is high, control risk is low, detection risk goes up, we'll do less work. But what I want you to remember is this relationship, there's an inverse. One goes up, the other goes down. Let's look at the opposite. If reliance is low, if I go out there and go, hey, before you make a sale, do you check people's credit? And they go, wow, I never thought of that. That would be a great idea. We go, okay, that's not good. Therefore, we can't rely on the receivables. Therefore, we better substantiate more of those receivables. Therefore, we'll do more testing. Remember the picture we drew earlier, 0 to 100? Here's materiality. Everything above that level is called the scope of our audit. That's how much we're going to look at. Everything below that, we're not going to audit. Why? Because we don't need absolute assurance. What are we looking for? Reasonable, based on cost, benefit, materiality. So what we're saying is, we don't need absolute, we need reasonable. Because if I wanted to audit every single $2 item, it would take me forever to come up with an opinion on these statements. So that's why we have that inverse relationship. So what it says here is that when we're looking at it, if reliance is high, therefore we can do less testing. That's our materiality. So I'm going to audit every receivable over $5,000 up to, let's say, $1 million. If, whatever the highest is, if reliance is low, then I go, there's no controls, I better do more work. Then I take materiality, decrease it to 2,000, which just increases the scope prime. I'll do more work. So that's where this falls in. Reliance is high, less substantive. Reliance is low, more substantive. Inverse relationship. So that's important. It's going to relate to both clarity. It's going to relate to both your PCAOB standards. So you'll see that in your notes, inverse relationship. Then we say, okay, so I've gone out there, I've planned it, I've looked at controls, I've obtained the evidence. Hey, now it's time to what? Let's draft the report. Okay, so now we're going to draft the report. So in drafting the report, we look at the reporting standards. And again, the reporting standards are still going to be similar under the clarity standards because they still exist. We still draft a report. It's just the report's a little bit different. So here's the reporting standards. All right, reporting STDs. Reporting standards. What are the reporting standards? The first one says accordance with GAAP. That means that the report should explicitly state, I'm going to say explicit. That means it explicitly states it's written in the report. It'll explicitly state, hey, these statements are presented in conformity with generally accepted accounting principles, GAAP. So it'll be principles generally accepted in the United States, or under clarity standards, what is it going to say? Under the applicable financial reporting framework, whatever that is. Generally GAAP, but it could be other things. So GAAP. The second one says no new principles, which basically means consistency. That's the consistent application of GAAP. Has GAAP been consistently applied from year to year? If it is, great. If it isn't, then we may have to mention it. If we agree with it, cool, we'll mention it and we'll put an opinion after, a paragraph after the opinion. An emphasis of a matter or an explanatory paragraph. If we don't agree, we go, dude, why did you change from FIFO to LIFO? Oh, just to make your numbers look better? I don't think so. We don't play that way. What are we going to do? Explanatory before the opinion. So we'll learn about where the paragraphs go in the reporting section, but it's important to understand the basics. No new principles. Consistency. That's the consistent application of what? Of GAAP. Or, for Clarity Project, consistent application of the applicable financial reporting framework. If you look in your notes, you'll see again, this is explicit, this is implicit. In other words, it is implied that it is consistent unless otherwise stated. So when you look at these statements, whose statements are these? Very good, Zach. They are management's. So when you look at the balance sheet, you'll see here's X1, X2, X3. We're assuming that if the numbers change, they change for a reason other than a change in principle. That's what we're looking at as far as the consistent application of whatever the standards are. The third one talks about omitted disclosures, none. Or I'll call that inadequate disclosure. So what they are, and this is also implicit. What they are implying, right? Explicit means stated, implicit, implied. What they're implying is that when you look at these statements, in the back are footnote disclosures. They're implying, hey, these footnote disclosures are adequate. So omitted disclosures, none. Everything's adequately disclosed. There's no inadequate disclosures. So that's what they're implying. So we're saying, okay, we'll imply, that's great. But if they are not adequate, then we have a problem. Then we have to adjust the report, either a qualified except for or an adverse, or we'll have to adjust the report somehow. So that's what we'll do under either clarity or under PCLB standards. We're going to have to adjust the opinion. The fourth one is why we all get paid the big bucks to be in public accounting. Why do we get paid the big bucks? In order to what? Express an opinion on the statements taken as a whole, or explain why an opinion cannot be given and give the reasons for not giving an opinion. So that's called explaining, or that is called expressing an opinion. So the fourth one is what? Express an opinion. And that's expressing an opinion on the statements taken as a whole. And as a whole means your opinion covers the statements and all the footnotes as well. So we'll mention it covers the balance sheet, income statement, cash flows, stockholders' equity, changes in equity, comprehensive income. Your opinion covers that and the footnotes and any other kind of information that's included in here. Your opinion may not cover the front pretty stuff. That's called other information we'll talk about down the road. That is other information that's provided by, because here's the pretty stuff. It says, hi, I'm CEO. Here's what we do. Here's the products we sell. Look, we're trying to make affordability and sustainability. One word. That's beautiful. And so it says, here's how we sell product. It's all the beautiful stuff. It's like raw, sis, boom, ba. It's the cheerleader stuff. It makes you want to invest in this company. I buy stock in this company. I feel good about myself. Okay, even though they don't give insurance to their employees and so on. Walmart. So that's expressing an opinion. So those are your 10 generally accepted auditing standards. Now again, we're going to cover all of these throughout the course. We're going to talk about how they affect clarity, how they affect, again, PCLB. Now, if you look in your notes, you'll see that memory, or mnemonic. The 10 generally accepted auditing standards are Tippy-canoe. Let's follow it down. Here we go. We've got training, independence, due professional care, planning, internal control, corroborative evidence. Accordance with GAAP, no new principles omitted and expressed. Or here's my 10 general, looks like 16, 10 generally accepted auditing standards, or TIPPICANOE. Now, this is important. What is it? Tippecanoe and Tyler 2. What does it stand for? The first three are called what, everybody? General. Next three standards of field work. Last four standards of reporting. What is the T, everyone? Technical training and proficiency. I, independence. P, due professional care. P, planning. I, internal control. Corroborative evidence. And then drafting the report. Accordance with the standards, the GAAP. No new principles, omitted disclosures, inadequate disclosure, expressing an opinion. That's your Tippecanoe. Now, I'm going to start every section with Tippecanoe, because I want you to understand where you are in the audit. It is so easy to get lost in the detail, right? You can't see the forest for the trees, right? Here's the forest, but I'm looking at the detail. So all of a sudden you get lost. That's where Tippecanoe applies to both public and non-public, because it helps you to stay focused as to where you are. So training, independence, do professional care. Then later on, we're going to talk about, okay, before I take the job and start doing field work, does the client have integrity? Okay, then if they do, okay, let's talk to the old auditor, predecessor auditor. Then let's go through and sign a contract called a written communication, an engagement letter. Then let's go through, and then we'll actually go through and we'll talk to the corporate governance, right? Those in charge of governance or the audit committee and so on. Then we plan it, look at internal control, obtain evidence, and then finally draft the report. So this is important to remember, because as we go through the course, we're going to go through the different sections. You'll see where we are. In the first section, we're talking about these. Then we go on and talk about professional standards, professional responsibility, ethics, reasons you might get sued, as we talked earlier about your exam, your update, right, from the State Board of Accountancy. It talks about, and I love looking for all my friends who messed up. This guy lacked independence in performing his audit as CFO, or working as CFO. This person grossly committed negligent acts while he performed his the work. There was no engagement planning. There was no management rep letter. There was no client attorney letter. There was no sufficient appropriate evidence. Basically, they just said, hey, let's not do anything, but we'll sign off on a report. Hello, you're in trouble. So all of that, and then we go through. So then the next area after professional responsibilities, we're going to look at internal control, obtain evidence. We're going to do statistical sampling. We're going to draft the report. We're going to look at IT. We're going to look at reviews and compilations. We're going to look at other types of engagements. It just gets better and better. We have such a good time. Such a good time. So that's what we're looking at. That would be your 10 general accepted auditing standards, a measure of the quality of the auditor's performance.